the death of fossil fuels, and I believe those rumors, which is why I invested in my Mitsubishi Outlander, which I love, but I have range anxiety because it only goes 32 miles before it needs to be recharged by the petrol side of my vehicle. So I was slightly ahead of the curve. So more fool me, I spent a lot of money on that car as well. Yeah, but there we go. So just to let you know, at just after 10:30, so after the minister's spoken, we'll be looking at the global and African context, developing in a bit more detail some of the things John was saying. And then after 11:35, John will be back to talk about local content, which people have been really, really focusing on and homing in on in the side event, but we'll do that in plenary here. And then at 12:20, we'll be focusing on Cameroon. We've dealt with Namibia, of course. We've dealt with Gabon. We've dealt with Côte d'Ivoire, soon DRC, and then Cameroon, addressing Cameroon's energy needs. And we'll build on through there. We've got the private lunch after 1:30. And then in the home straight, we've got a Ghana bidding round. People are getting very, very excited about the Ghana bidding round. Let's see if it's as successful as the Côte d'Ivoire one was last year. They gave 17 licenses in the wake of Africa Oil Week 2017. Building up to the live broadcast very, very shortly. And if you have your phones, okay? Thank you very much.
1 minute, you've done so well.
Okay.
Thank you. Round of applause.
We are going, as was eloquently said, into a live broadcast. We'll be live across the African continent, broadcasting to 48 countries across Africa for 60 minutes. For 60 minutes, we're live. And you'll hear the television voice go on in a moment when you cue me. Thank you. Welcome to this live CNBC Africa broadcast coming to you from Africa Oil Week, which is currently in session here in Cape Town at the Cape Town International Convention Center. We're talking about global funding strategies and mergers and acquisitions in Africa upstream. Joining me on the panel to take the discussion further, to my immediate left, Frank Pluta, who is the Energy Group Head, Energy and Natural Resources at Natixis. We are joined by Camillo Atampugre, who is the natural resources expert at ABSA Capital, Somit Varma, who is Managing Director, Warburg Pincus, and Paul McDade, who is the CEO of Tullow Oil. Gentlemen, thank you very much. And we're going to jump into the energy environment for the next 60 minutes. Paul, I know you made the keynote address at Africa Oil Week in 2017. Very different viewpoint when it came to the oil price. So I thought it would be great if we look at where we are today and how the oil price has changed sentiment when it comes to global funding and M&A in African upstream.
Yeah, thanks, Ron. It does feel like a long time since 12 months ago, and things have changed substantially. When I talked last year, I think we felt we were coming into recovery. I think as we sit here, you can just tell from the mood in the conference that we are well into the recovery. We've seen prices get up higher than 80. That makes a difference. I think the recovery in the oil price, we're back at sustainable levels. Where we got to in 2015-16 was just unsustainable for the business, whether it be the oil companies, the contracting side of our business, or even the host nations, just unsustainable. So, you know, I think we're back. We've been able to repair balance sheets, and we're very much feeling we're back in a period of growth.
So, in your keynote address, you spoke about certainty. When you say we're back at a sustainable level, is there enough visibility in terms of the oil price going forward, or are you expecting further volatility?
I think we're going into a different period. I mean, over the 30 years I've been in the industry, we've had many ups and many downs, and this one feels a little bit different. And I say that because I think we have unconventional shale as a backdrop. We didn't have that before. We've got energy transition ahead of us. We didn't have that before. So I think we're going to see a price that's slightly more range-bound by those factors, but I do think we're going to see more short-term volatility than we've seen in past cycles.
So the energy mix ignited a reaction from you in terms of how it has changed and how it will perhaps weigh on the oil price going forward.
Yeah, I mean, clearly.
So I just wanted Somit to come in here. You gave a reaction when Paul spoke to the change in the energy mix in the US shale gas environment. Do you want to weigh in at this point?
So I think Paul's absolutely right. I think in the short term, we expect to see significant volatility. And the volatility is going to come from different pieces of it. There is the new sanctions on Iran. There is Venezuela's dropping at 60,000 barrels a day per month. You've got Iraq and Saudi Arabia and Russia opening up the tab. So you're going to see short-term volatility. But in my opinion, in the medium term, the swing producer is going to be the shale business. And so the way, at least I think about it, is what is the marginal cost of getting a shale barrel in the market? And so longer term, I think Paul's absolutely right. It's going to be range bound. I don't think you may see some short-term spikes or falls, as you saw in the last few weeks, but I think you're going to be pretty much range bound.
Camillo, we may see some diversification strategies in terms of trying to reduce risk in terms of the energy mix out there, but give me your sense of the landscape as you see it. This is what you eat and breathe on a daily basis.
Yes, definitely. I think with the oil price uptake, there's a lot more activity in the market. I agree with what's been said before in terms of the swing producer being the US, but when we look at the long term or the medium term, we know that there's a requirement for conventional production to come onto the market. Demand is still growing at least 1 million barrels per day. With the oil price decline, there was a lack of investment going into the sector. So there's definitely a view that there may be a supply crunch at some point, and that's what's really driving some of the new investments that we're seeing today.
So Frank, Paul made the reference to the many cycles over the number of years that you've all been playing in the oil and gas industry. Weigh in with the oil price context before we move to funding strategies and Africa and how we are embracing Africa, how we're embracing foreign direct investment across the African continent.
Well, the market has clearly changed over the last 2 years. I would say, of course, with oil prices sitting where they are today, it's much easier for banks to finance transactions. That being said, if you look back over the last 20 years, you can see that most of the nice projects, the good projects, with the right management teams and the right assets, they've been financed. So I believe that, of course, oil price is an important factor in all the transactions we are looking at. But at the end of the day, when we make the right assessment on the packages, we are seeing, we can finance the deals. And that's what happens today.
So it's the quality of the assets that you are focusing on.
As always. There's an important factor, I think, today in the environment we see, particularly in Africa. That's the change in the liquidity environment and the liquidity that is available to the companies. What we had like 10, 15 years ago was mostly international banks being very active and lending to oil and gas companies all over Africa. That has changed a bit today. What we see today is still international banks being present, but a lot of banks have left the market, international banks, partly American banks are not there anymore. A lot of them have left this market. But what we see is that we have private equity coming into the market, and not only for equity, they can also be there for lending. We see also the big traders helping to finance the transactions in Africa.
When you say we see private equity coming into the market, what stage are we at, Somit?
So, if I can take that question and maybe focus it a little bit on the African continent. Private equity is very, very active in North America. In the African continent, I would say that private equity investing is still in some of the early stages because of what private equity perceives are some of the above-ground risks. So, the way we think about it, there are two things which you have to manage when you're investing in upstream. You've got to start with the rocks below ground, but then you've got to, at the same time, really think of all the above-ground risk, and those are, numerous. Well,
we actually need to touch on them, because that is the bottom line when it comes to global funding strategies and M&A. So let's talk about those above-the-ground risks, because, again, to the 48 countries across Africa watching, I think it's important that the international community shares their views in terms of if you need to attract capital, these are the things that you need to ensure before we enter your market. So can you unpack some of the key above-the-ground risks?
So for us, I would start off by saying that the above-ground risk, we've got to think of, and we think of it in they are in some ways connected, but they are quite distinct. So there is the whole regulatory environment, the fiscal terms. How do you deal with the local communities around that? How do they see that they're getting benefit from what you're doing? And it's not about charity. It's about actually making sustainable differences with the communities around it.
The term that's being used widely is inclusive growth when it comes to sustaining local communities. It's
because it's a very capital-intensive industry, you need to make sure that the rules of the game are not flipped around, because capital is fungible. So we at Warburg, we are one of the largest international energy investors. And for us, we are in some ways agnostic in terms of where that capital goes. It has to go to places which welcome capital, where you can say there's stability, where you can say, I can do this over the next 5 to 10 years, build something of scale, and make a fair return.
So I want to stay there, and let's focus on the fiscal environment, the regulatory environment when it comes to long-term capital being deployed, which is, oil and gas is a long-term game, and if you're going to put billions of dollars into an African economy, or any emerging market economy, you need to know that the rules of the game are not going to change, Paul. Now, Tullow, I understand, has a presence in 16 countries across the African continent, heavy presence in East Africa and West Africa. Give us a sense of what you're seeing. I don't like to use the phrase, but I have to, on the ground.
You're right. As a minister said to me the other day, you're actually an African company based in London, and your strategy is Africa. And that's very true. It's a good way to sum it up. So
we may coax you onto the continent in terms of your head office.
We're here. We've built a very viable and sustainable business across the continent over the last 30 years. So it can be done. And really, it's contract and fiscal stability has been critical over the years, and we've talked a lot about it at this conference over the last decade. I think it's less of a challenge today, because I think the countries really do understand that contract and fiscal stability is important, and they adhere. And the structures we put in place suit that. So I think it's less about contract and fiscal stability. I think we're very much seeing that in most countries in the continent. Actually, as I spoke on Monday, it's more about the pace of decision-making. There's huge competition for capital. We see that as we go to the capital markets and try and attract capital into our company to spend in Africa. And whilst that question about contract stability comes up, I think we're able to show that that's less of an issue today. But the decision-making and the pace of decision-making
So drill down into that. Give us an example on what you now look at in terms of, or what you would want in a decision-making process. How quickly would you want people to react and make a decision on projects going forward?
Well, we go through our phases. We spend a lot of risk money on the exploration phase. Sometimes it runs into billions of dollars. That is sunk capital that we don't see any return until we start producing the oil or the gas out of the ground. And really, what we found working in some of the countries is we've been able to move in a slightly faster track to move from exploration success into development, and that is absolutely critical. I think it's true for everyone sitting here on the panel, that pace. And I think that's why there was a sudden rush in capital flight to the shale, because people had the perception, and it was really a true perception, it was a fact that if you decided to spend money today, you could see returns tomorrow. And really, I think that has to be a theme today in Africa. The pace of decision-making needs to be the key aspect that government, regulators, and companies we're all focused on, because we can improve it.
Interesting that you bring that to the table, because at the Africa Investment Forum yesterday in the plenary, one of the key phrases was speed up, scale up, and synergize. So on the speed element, this is a good message to send out to Africa that decision-making needs to take place quickly. Yeah. Frank?
Yeah, well, I think to Paul's point on fiscal stability first, I would not say that has been an issue over the last 20 years. Actually, when you look at what happens in all the countries we've been financing over the last 20 years, there's not been so much change in terms of tax regime.
But I think also, let's get a bit of context onto the table. I mean, we've got Tullow operating in 16 countries in Africa. Frank, when you say the projects that you've been financing,
Yep.
how many countries are we talking about? There are 54 in Africa, so a lot of the countries are still lagging from a fiscal perspective.
Well, I'm talking about the countries that have been very active over the last 20 years in that business, obviously, and most of them, Tullow is of course a very active player in. So fiscal stability for me has not been an issue, and actually maybe you can think about it and look that maybe Australia or the UK have been more volatile in terms of tax regimes than Africa as a whole. But coming back to the other part of the question on necessity of speed in action, I think that's really the key point today. And thinking about companies or private equity firms like Warburg looking at potential acquisitions, anytime we are talking about potential acquisitions in Africa, the question is not necessarily about how we're going to fund the transaction and how we're going to make it work. The question is usually how long is it going to be until we get the government approval for the transaction to be finally approved. So that's surely one key point for the future.
Camillo, before I come to you, Somit wants to come in.
Yeah. So I think that's a critical point because we have to think of, as private equity, we think of it as a risk-adjusted return. So on the shale business, we can get our cash flows very quickly and recycle them, and there's a huge return to all the players because you're able to recycle that cash flow quickly. In the case, if there's a long delay, you put in your exploration dollars for 4 or 5 years, and you're not getting the approvals, and not getting decision-making, and therefore you're not getting oil out of the ground to market, and are not able to monetize it, it has a huge impact not only on your return, but to what the country gets. Remember, on all of these investments, the country has a very significant take. And so they themselves are hurt if they take longer.
Let me ask you this. The decision-making process, and we're talking about basically the public sector decision-making process, is that not the tail end of the regulatory framework that needs to play catch-up? Somit, I'm still with you.
So it depends from country to country, right? So there are certain countries today where decision-making continues to be slow for whatever reason. There are some countries who realize that we need to move that needle because, to my earlier point, capital is fungible. And there are a lot of investments all over the world which are really, really need the capital, and equity markets, for the most part, are quite weak. The debt markets internationally, unlike the US, the debt markets are also closed. So capital is able to pick and choose where it wants to go.
Camillo, you're seeing the same trends from an ABSA Capital perspective?
Yeah, so just to add to Sumit's point, so you've seen examples on the continent where some countries are a lot better than others in terms of the approval process, encouraging the sector. I think Paul probably agreed that in Ghana, where we saw a discovery in 2007 come to production within 3 years, it was a very good example. If we look at places like Tanzania, where things have taken a lot longer, so clearly from a funding perspective and investors, the trend is to move towards the countries which are a lot more encouraging of investment into the sector.
Can we talk countries? Ghana, Tanzania on the table. Paul?
Yeah, I think you raise a very good example in Ghana. We discovered the Jubilee field, a major discovery in middle of 2007, and we had an industry-beating timeline to first oil. We brought that field on stream in the end of 2010, which maybe for some other industries might sound like a long time, but normally the cycle time from discovery to first oil would be 6-7 years. We did it in about 40 months. So I think, as I said on Monday here at the conference, all the ingredients are there in Africa for us to compete globally. The ingredients, the physical ingredients, are all there. And I think that example at Jubilee is a great one that says when the parties come together, the regulator, the government, and the private sector and the financiers come together and work hard within Africa, we can do spectacular things. But there are the other examples
exactly,
elsewhere where...
Let's talk about some of the other examples. You know, I want to have honest conversations here. So Camillo's tabled Tanzania as having a very slow decision-making process. Is that correct? I don't want to put words in your mouth.
Yeah, that's correct.
Correct? Paul, your experience in terms of those countries that are lagging?
Well, I think what we have to understand with some of the countries, especially a company like us, we tend to go to the frontier. So we make big discoveries, often in countries that haven't had oil and gas. And, you know, oil and gas is quite emotive and political, and therefore different countries sort of take a different amount of time to kind of move the industry forward, especially once it's established, it's not so much of a problem. Then you're into small-time decision-making, just approvals or regulatory. You know, at the very front end, when a country is trying to decide that what are they going to do with this one-off wealth that is going to come, and there is great appropriate concerns about then the use of revenue and the establishment of the sovereign wealth fund or whatever. So these are kind of very big issues.
It's a complex environment.
Very complex. And I think just different countries take different times to kind of settle how they're going to go about the industry. And we've seen a variety.
Frank, can we chat about a couple of the other above-the-ground risks when it comes to global funding strategies in Africa upstream?
Well, you know, usual above-the-ground risk in all the transactions we are looking at is, of course, operational risk. You know, a place like Nigeria has proved to be difficult in terms of evacuating oil because of all the issues on the pipelines. But that's something that usually the companies have managed properly. So it's really a matter of the operator you have in front of you and the way he's going to take care of the way he's going to evacuate the oil, particularly. So you see companies who have managed to get backup scenarios where they can manage it properly. But that's something that can be managed. So again, as I mentioned earlier, as long as you have the right project in front of you with the right management team, you always find solutions.
How many of the right projects with the right management team are there still out there in Africa? Camillo, let's get a sense. And Somit, this is what you look for on a daily basis. Are these deals, are they easy to come by?
I think it's important to understand that...
You should mention Tullow first.
It's important to understand that banks like ABSA are now backing only the companies that have the right management, the right expertise, the right track record on the continent, and who are focused on, you know, their operations, focused on local content, which is linked to what Frank was saying about some of the above-ground risks. We see that in places like Nigeria, you can really manage some of the above-ground risks by ensuring that you have a good local content policy, bringing the community to be part of the project. And for us, that's a big focus for us, and it links to what you said before about sustainability of projects and the sector on the continent.
The local content, let's touch on that. And Paul, if you can take me a little bit further on this side, finding the right local partner.
Yeah, I mean, maybe just to the asset first and the right management team. I think one thing, you know, the downturn that we saw, which was very severe, I think really started to differentiate. Not the assets stayed the same, but the management teams and how they managed the above-ground risk and the financial risk. I mean, it was a great filter. And those that were still standing with with a business at the end of it, because it's relatively easy to get in there and make money when oil price is at $120 a barrel. You know, when you go from 120 to 30 and you can still manage all the operational financial aspects, that shows, I think, a differentiation in the skill of the management team. I think when we look at some of the risks, I mean, I think nowadays the operational risk, even frontier areas where we've gone into, you know, they are still establishing regulation. We have very good international regulation, and we can apply that in standards. We apply it going into a country as they put in place their own regulation. There's other countries that we go into, and they have very good regulation. So I think the operational, the environmental, the health and safety, the industry, you know, has very high standards. In general, most professional teams will apply those. I think the really interesting area has been the last decade, the shared prosperity is how we like to talk about it at Tullow. We've had that as a big agenda, and that comes to the community. The fact that this oil belongs to the country, not the oil companies, and therefore it's about making sure there's maximum benefit to the country, not just through revenue, but through employment, local content. So that's been a big agenda for us over the last decade. I think as we look forward, environmental stewardship is really the next big item that we need to think about as we go into the energy transition. You know, we are geographically focused in Africa, and we're focused on oil. Yeah, we are not planning to go into renewables as a company. We know our focus. Therefore, I think environmental stewardship for us will become a really key important of how we show many stakeholders globally that it is appropriate to continue to develop these hydrocarbon resources for the countries we're in.
Somit?
So I want to actually go back to management teams, because that's what we at Warburg do for a living, is we back exceptional teams with patient capital to go build a business of scale over a period of time. You know, the perfect example which comes to my mind is we set up Cosmos in 2004. Just a team, no assets. Then they drilled their first well in Ghana in 2007 and had a $1 billion barrel discovery. And we've got 4 companies in Africa now. But finding the right team, and we have a program at Warburg called Entrepreneur in Residence, which is basically where we find talented individuals, bring them in-house, spend several months with them, thinking through a business plan. Why do you want to play in that country, in that kind of geological play?
So you find these talented individuals in country,
well,
in Africa?
Across the globe.
Across the globe.
Across the globe. But clearly, what we won't do is pick individuals who have spent their whole life working in Canada and suddenly say, go do something in Africa. That doesn't work, right? So people who have worked in emerging markets can understand the above ground things. And we set up the team over, you know, it takes a lot of hard work and time and effort to set up that team, give them capital, and go and then be patient with it, and then go invest that capital. And this is a capital-intensive business. So it's finding the right team. So the way we think about it at Warburg, you can take an average asset and make a really good return with an exceptional team, or you can take a really good asset and destroy value with a mediocre team.
We have to stay with skills across the African continent and the development of skills in Africa oil and gas environment. Your experience, Camillo, I mean, we've got very different viewpoints coming across, and what is great is we're seeing skills transfer. When we took a look at Tullow and we look at Warburg, there's a lot of skills transfer happening. But the reality of the skills on the ground when it comes to oil and gas.
Yeah, so that's a very good question. It's very challenging. I think in some of the countries that we're looking at, the emerging frontiers, there's clearly the beginning of a sector. So there's definitely a skill shortage. Some of the companies are very good in terms, you know, for example, Tullow, who are training people on the ground. There's programs in place for them to go abroad to learn about the industry and then bring those skills back. So what we're seeing from governments is that, you know, there is a big push around this local content policy to ensure that there is some transfer of skills, but at the beginning of some of these countries' journey in the oil and gas sector, it is very challenging to find the right skills in country.
Frank, do you concur with Camillo?
Yeah, I think he's right.
Let's talk now about the environmental stewardship that you tabled, but I want to talk about it, Paul, in the manner that it's impacting funding strategies when it comes to oil and gas, and certainly also mergers and acquisitions in African upstream. I mean, is it changing the models? Because you've got to take into account environmental stewardship, and I've come from many debates in this space, and even with Al Gore, that if you've actually got to make people pay to change their, potentially, to change the way that they do business. Would that be fair?
Yeah, I mean, I think we've always managed the environment as an industry but it's tended to be focused more not on carbon footprint. It's tended to be more on making sure that where we go, we have minimum impact, and we don't spill oil, or we don't affect gas. So the environmental aspects of the oil and gas industry have been more focused in the past around that, just very good regulation, very good management of the environmental aspects. I think the stewardship piece is much broader. I think as you look forward, the countries on the continent must be allowed to develop their natural resources. We in the OECD countries have had our chance. We have developed our natural resources, and in many ways, and historically, we've not done it in a very sustainable manner. I think in the continent, what we can do is we can work with the countries to show that they can develop the oil. The demand will be there, whether it's in 2040 or beyond, there'll be significant demand, it will be there. And the countries in Africa need the resources for their economic development.
Well, 623 million people in Africa don't have access to energy.
Yeah.
The stats on the table, that's half the population.
Yeah, so we don't have a choice as Tullow. You know, we're focused on Africa, we're focused on oil. So I think it's more about thinking about our carbon footprint and the whole climate change agenda. We need to play into that and actually then work with the governments in the same way as we did under the shared prosperity agenda on a much broader space. And that's how we're starting to think about it at Tullow and have been over the last couple of years, and you'll see more activity in that direction.
How high on the agenda is climate change and the risks associated with climate change when it comes to private equity, specifically at Warburg?
So I just want to pick up from where Paul said. So for all our portfolio companies, the environment piece is part of the DNA of the management teams. It is the culture. There's a reputation risk is very significant, not only to our portfolio companies, but to the Warburg brand, if we don't do those things right. And there used to be a thinking about do no harm. That is an outdated thought. It is now doing good. It's not about doing no harm.
It's about how you're improving the world.
Exactly. It's about, what is your footprint? How do the communities benefit? Is it sustainable? It's not about just saying, okay, we helped set up a school. And then you realize the school is empty because you don't have qualified teachers. So how do you make sure there is that sustainability is there? And it's really the ownership is we try in our portfolio companies as they work with communities is try and instill an ownership within the community and work hand in hand. It's just, they don't see it as a charity. They actually have ownership of it. They feel good about it. They want to take it to the next step. Coming to your point on climate change, climate change is a fact of life. But I also feel that EV, electric vehicles, solar, wind, you can see their trajectory, right? They're continuing to grow in demand. But that doesn't mean that the oil and gas industry is dead, right? We think the oil and gas demand, it's today about 100 million barrels. We expect that to continue to grow. And if you think about the EV vehicles, a lot of them, are hybrid. They need electricity to be charged. To generate the electricity, you need to burn natural gas or coal. So people don't close that whole circle when they think about electric vehicles. You need the raw material to generate electricity to power the EVs. So it's an interesting.
Let's stay with this, the balance between what you would finance in the renewable space versus your traditional oil and gas environment.
Well, that's a very good point. Of course, we're here talking about energy transition. We're not talking about we were oil and gas 100%, and then we are moving to something else. Actually, that would not work today because we would not have the capacity to, to give energy to everyone. And you don't have enough energy in Africa, for instance, today. So I think the whole question for a bank, and bank like Natixis, is to say, of course, we are working on renewables, on wind farms, on solar, and so on. But still, we need oil and gas. And this is something that we are going to continue to finance because this is something we need and the world needs. The key thing, of course, is we need to make sure that the impact we have on the world is minimum. And this is an absolute requirement for any transaction we finance. Maybe the banks and all the private equity and others who are maybe a bit more flexible on these questions 30 years ago. I'm really talking a long time ago. But over the last 20 years, all the transactions I've seen were, a key requirement was, of course, to make sure that environment was properly managed. There are these famous Equator principles in banking where you can't do, stupid things in terms of environment and impact on environment with the projects you are financing. So I think, on one hand, we are doing well in terms of making sure that the impact on environment is very, very minimum, that we are not doing anything wrong. We're, of course, taking on board the energy transition, but for instance, my bank is very committed to oil and gas because we believe this is something we still need, and we still need to finance, particularly in Africa.
Camillo?
Just to add on to that is one point really is that given the big push around climate change, what we are seeing within the oil and gas mix is that gas is now becoming more prominent. So we're seeing big gas developments coming on stream. We're seeing regasification terminals on the continent to feed into the gas to power story. So that's one aspect where the whole issue around climate change is actually driving one particular part of the oil and gas value chain.
So we've got 24 minutes left in terms of discussion. Let's move to tomorrow and beyond, and how you see the game changing, given the current landscape, and how, for instance, Tullow will be looking at projects into the 5, 10, 15-year space in Africa.
Yeah, I think kind of post the downturn, one key area as we look forward with these projects is we can't bank on very high oil prices in the future. So I think as we look at the future, we put quite stringent, let's say, criteria into our evaluation. Because these projects, you invest today and you get the revenue over the next 20 years. So I think that's one area where we're quite prudent about our expectations on oil price, because I think we will see this kind of lower levels with less very high periods of very high.
And you work that risk into the asset prices?
Yeah, and really, look, our industry is quite simple. We have the commodity price, we have the cost of, the operating cost, the capital cost, and we have the fiscal contract with the government. And it's those three things that determine the viability of our projects. I think we have a different view looking forward on oil price than we maybe had 5 years ago. I think on the cost base, though, we've made significant inroads into our cost. At Tullow, we're running the company for about half of what we were running it for in 2014. Wells that we're drilling offshore in deep water, we're drilling them for about 40% less than we were. So our cost base has come down.
And as you said earlier, this is applicable across the oil and gas industry. Everybody has had to relook at their operational efficiencies.
Absolutely. So, and then the third component is the fiscal contract. The good structure we have in the emerging markets is we sign a contract at the beginning with the government, and generally that will define the fiscal and contract terms for the next 25 years. So you've got that certainty at the beginning, which is different to some of the more developed countries. So these three components, we still have very viable developments, even out in the deep water, even complex onshore projects we're involved with very long pipelines. These projects still work today because we have the right fiscal terms, and we've managed to reduce the cost significantly.
Somit, you're looking out here at the future and specifically bringing to bear the private equity discussion.
Right, and so, Africa will continue to remain, for us, an area of focus. People forget that Africa today continues to be highly underexplored. If you look at the well densities in Africa relative to some other parts of the world, it's highly underexplored. And for us, it's less about where oil prices are. I cannot control that variable. So the way we think about this business is, for us, it's a margin business. So we expect our portfolio companies to be the lowest on the cost curve, because we can control how you allocate capital, how you have your operating cost, how's your capex per barrel. So that's the piece we can control. And oil prices will fluctuate, but we believe that as long as you're the lowest on the cost curve, you're going to make your return. And invested over 14 billion across 90 investments globally along the energy value chain. In Africa, we started investing about 15 years ago. Our initial investment was when we set up Cosmos, and we continue to be the largest. They're playing the Atlantic margin. We continue to be the largest institutional investor in Cosmos. Since then, we have made 3 other large investments with 3 other large companies. We have a company called Trident, which recently went and bought Hess's assets in Equatorial Guinea. We then have a company called Telonex, which has got assets in Chad. It's got assets in Kenya, and was recently part of a consortium to buy Petrobras's assets in Nigeria. And then we've got a company in Egypt called Apex, which has got 2 fields in the Western Desert. So for us, it comes back to finding exceptional management teams, thinking through the play, what's their area of expertise, what's their skill set, why do we want to play in that, how can you make sure...
I mean, you mentioned a lot of activity in Africa. If you look to the future, do you think that activity is going to pick up from current levels?
It's hard for me to say whether it's going to pick up or go down, but we are always looking for entrepreneurial teams to think through investment opportunities in Africa. Africa will continue to be a focus, and it's, clearly upstream is our bread and butter of what we do, but when you look at the whole value chain, so the massive gas discoveries offshore Mozambique, they would have an impact on the value chain, whether it's LNG, gas to power, gathering and processing systems. So there will continue to be opportunities, and we think that as one of the few private equity firms which really understands emerging markets, understands Africa, that we'll continue to really lean forward to put capital to work.
One of the big criticisms when it comes to allocating capital, we've all said the capital's there, it's looking for a home. But we often stumble in Africa when it comes to getting those projects to bankability. And you mentioned the Equator Principles earlier. So the consulting and the due diligence that needs to go into crafting these deals sometimes falters at those last stages. Your thoughts on bankability and whether going forward we're going to see more attention to all the steps along the way. We're talking about long, enormous projects that you're getting involved in. Camillo, bankability?
Yeah, look, I think... for a number of the big projects, Somit just mentioned the projects in Mozambique. These are transformational projects for the country. It's, we're talking $20, $50 billion projects which will transform the economy there. So it's quite important to line up all the key stakeholders to ensure that there's alignment with the government, with the sponsors, with the banks. There will be a number of banks which will be involved in that. And it's basically ensuring that everybody's lined up in terms of approval processes, building the infrastructure in country to support the industry. So I think going forward, how we see it from ABSA being a Pan-African bank, is that there will be a lot more collaboration by the different stakeholders in the sector, including oil services companies, to basically help fund these projects and bring them
to bankability.
Yeah.
I think maybe just to add on that point, I think the difficulty today for the big projects is the the variety of stakeholders that you need to have around the table. There has been a time where it was enough to have an underwriting from a number of international banks, and the deal was done. That could have been done quickly. That's not the case today, because as I mentioned earlier, a number of banks have left that market, and that requires today to go to private equity, to go to the traders, to go to credit funds, to go to export credit agency, to make a financing package working.
Paul, you wanted to add?
Yeah, I think one of the things is I talked to the capital markets and banks. I do think a lot of it is about perception of risk rather than real risk. And I think, Africa...
There's a mismatch.
I think there's a mismatch. When I spend time in the US and New York or West Coast or London or Europe, and I talk to the people that have control of billions of dollars, I have to say sometimes their understanding of Africa, the continent, really needs to be a little bit deeper. And of course, like anything in life, if you don't have a full understanding, sometimes you can take a more kind of risk position.
Especially when there are other opportunities that you perhaps understand better.
Exactly, and I think this was the capital flight to shale. We go back to the shale. I think it was a lot to do with, the huge capital fund sitting in the US, and suddenly there's an opportunity to invest it in my backyard where I really understand, or I perceive I really understand, and rather than send it to Africa where I don't understand and I have perceptions of very high risk. And I think there is a real mismatch between the reality on the ground here in Africa and many of the perceptions that are there. If you look at shale, the flight of capital into shale, there was a lot of losses taken in that flight of capital. And a lot of the entities there, are still not, thankfully the capital markets are now requesting them to deliver some free cash flow, because over the years, it hasn't been there. So there's sometimes as much risk there, but the perception of risk is different.
Do you agree, Somit? There's a gap between perception and reality, and actually the situation, if I'm reading you correctly, Paul, is much better than many of the capital pools out there deem it to be.
I think Paul's absolutely right. I mean, is when you just, read a newspaper and get your risk assessment from newspapers and magazines, other than having actually boots on the ground, you try and layer the investment with multiple levels of risk because you just don't understand the actual risk which you're taking. So for us, being a global investor, all our investments, whether it's in the US or internationally, we actually think of it on a risk-adjusted basis. So a lot of the international investments, on an absolute basis, right, in terms of absolute return, are excellent. And then we have to ask ourselves, okay, so if I do that, how long would it take me to get my money back? What other money do I have to spend on some of the other ancillary things? And so on a risk-adjusted basis, how would that stack up with, to take Paul's example, against a risk-adjusted investment in the US? And it's investment-specific. It's hard to paint a blanket picture to say, oh, I can do something in Ghana, but I can't do it in Kenya. That's not the way we think about it. We are not going to take things to the lowest common denominator. Every investment needs to be assessed on its own merit, whether it's in the US or internationally. And like I said, we've got 4 investments in Africa.
Can I try and reach for a tangible example there? If you look at the costs associated with infrastructure development, wouldn't that be a big swing factor in terms of investing in Africa, specifically in upstream?
I think that's right. I think we've got to think of these investments on what we call a full cycle basis. You can't just think of what's the return on a single well. You've got to think of it. It's the exploration, it's the development, it's the infrastructure to monetize it, it's your corporate G&A. Overall, what's the return? And infrastructure relative to some of, in Africa, relative to some of the other parts of the world, is not that well developed. And so therefore, time to monetize discoveries becomes a big factor. And I think Paul can talk,
I want to bring it to Paul here because, I mean, you've given a very clear indication that regulatory frameworks, fiscal frameworks have changed for a more favorable environment over the time that you've operated across Africa. Your sense of that infrastructure, is this again a perception versus reality? I mean, Ghana, we know, is firing on all cylinders when it comes to infrastructure. But perhaps you can just give us a sense of what you've seen and how it's changed and whether we really are starting to make inroads.
Well, I think it varies, and it varies from country to country, and situation to situation. I mean, the regulatory and the establishment of contract, etc. I think that has evolved enormously over the period, and I think we see good regulation and the demand for high standards across the majority of countries across the continent. With regard to infrastructure, for us, we're maybe a particular type of company because we're out in the frontier. And when you're out in the frontier, there tends to be less infrastructure. So some of the countries we work in where it's a well-established oil and gas field industry, we have the infrastructure. We go and we make a discovery and we can tie it in 6 months, in the same way as you can do in most established places elsewhere globally. And then we go to some frontier areas where, you know, we're maybe 1,400 kilometers away from the market or 600 kilometers away from the market.
And there's no road infrastructure.
And there's limited infrastructure, you know, but that's just the same as going to any other part of the world. If you go to the middle of Australia, and I guess I'm not familiar with the projects there, but I could guess that some of the big projects that have been done in Australia have lacked infrastructure, and the oil companies have had to put them in there.
Well, you're a great advocate for Africa. You're making us feel very good as Africans in the room. But I want to talk about corruption. And Frank, you're going to chat to me about that, because we're talking about funding strategies, and we can't ignore the fact that corruption does still exist, especially when it comes to financing, when it comes to including local partners. Give us your experience.
Well, that's a difficult question. You know, what can I say on that one of corruption? There's nothing we can do about transactions where there would be corruption. If, you know, this is not something we can do, obviously. So.
But what I'm asking you is, I mean, because
I mean, for us, it's just about proper due diligence and making sure that we are working with the right partners. So there's no way we can finance transactions where there has been any kind of possibility
of corruption. We know you definitely, as Natixis, would not go into any corrupt transactions, and certainly neither would ABSA Capital, nor Warburg, nor Tullow. My question is more about how often do your teams in country experience approaches on corruption? Or is that, again, something that shouldn't be tabled at this discussion?
Well, I think there is a lot of, you know, again, perception about corruption in Africa. I've not had many situations where I heard about corruptions on transactions I was working on. Not so many, honestly.
ABSA Capital?
Well, I guess adding on to that is that, yes, we have seen in the past where there has been corruption around particular assets, which has impacted a bit further along the line. I think what the banks have done, and in particular the case of ABSA Capital, is to ensure that we have a very good compliance team. It links back to my initial point around the management team and diligence in that management team. We do background checks into, you know, how contracts were gained, and so forth, in order to get comfort around that. So there's a constant checking process. But, you know, to your point, I think with corruption and fraud, you know, it creates uncertainty in the market, which is never good for funding or investment.
Somit, you mentioned earlier that the discovery of gas in Mozambique is transformative for the economy in general. So again, you would anticipate that the government is now dealing with an asset that could change the game completely. It's a new discovery, relatively speaking. They don't necessarily have all the rules of the game. There may be people who want to make a quick buck here and there. Is that a feasible scenario?
I can't speak specifically to that, but at least from the way we sit, you know, I don't think corruption is, you can say it's an Africa issue, it's a Latin America or a US issue. I just think that governments know they're a lot more educated today. They know that if the country is perceived to be corrupt, capital is going to flow elsewhere. It's in my mind, it's really, the bottom line comes down to that. If they know that the world itself today has changed dramatically in that fashion, whether it's the FCPA's rule in the US or the UK Bribery Act. I mean, there's an intense pressure to be transparent and clean, and governments across the world understand that. Otherwise, they're going to lose capital. And on the Warburg side, you know, our management teams are just clear. You know, we just say no. Everybody is very focused to make sure that, you know, things are transparent and that your reputation is not tainted.
Paul, have your management teams seen a change? So we've chatted about the regulatory environment, that's taken a step up in the right direction. We've chatted about infrastructure that differs country by country, as you've put on the table. But what about corruption? Has there been, I mean, again, we look at your history and your experience of operating across the African continent. Has it changed significantly?
I mean, look, we've built a company, a successful company in Africa over 30 years. And that ability to build a successful company and create value for all of our stakeholders has not been impacted by fraud or corruption. I think the point I'd pick on here is that what's been very helpful more recently is the Foreign Corrupt Practices Act and the UK Bribery Act, because what that's done is just put down on paper and good regulation that applies globally to companies. So it puts a framework to the basis that we've always worked as a company. And actually it's very helpful because it sets out very clearly expectations of international businesses such as ours. So, I think having that regulation from the US or the UK, I think has been very helpful. We're doing the same thing post the regulation as we were pre, but that's not to say that it's very helpful having it out there so that everyone fully understands the expectations of our capital markets and our governments.
We're coming to the last 5 minutes, and this is where I give you the space to share your thoughts, to remind you that there are 48 countries across the African continent who have tuned in to this broadcast this morning. We come back to the topic at hand, global funding strategies and mergers and acquisitions in African upstream. So I'm going to ask you, and Frank, I'm going to start with you, in terms of your final word when it comes to this topic and what you want people to take away from the conversation that we've had on the stage today.
Sure. Well, I think there was an interesting point that we touched on during this discussion. It's about perception of risk. And it's funny to consider that over the last 5 years, and particularly when oil prices were down, a huge number of companies went to bankruptcy in the US. Oil and gas companies went to bankruptcy in the US because the oil price was crashing, where at the same time, almost no oil and gas company went to bankruptcy in Africa. The reason for that is, most of the time, a lot of, capital markets or banks would arbitrage between the technical risk and the country risk and the political risk. So on one hand, you would have, capital markets going to a very technical, very high technical risk in the US, whereas they would not do the same in Africa because they would consider, oh my God, we've got some political risk here, so we have to balance it. At the end of the day, the result is that there is a huge number of opportunities today in Africa that we can finance, but the matter still is the perception of the country risk. So this is something a bank like Natixis is happy with.
So close the gap between perception and reality.
Exactly.
Camillo.
Yeah, so I think from ABSA perspective, as a Pan-African bank, we're focused on the continent. So for us, oil and gas is a key sector for us. We want to ensure that there's sustainability in that sector, and that basically talks to local content, indigenization, ensuring that there is knowledge transfer to the continent, and so that the resources can be capitalized in order to really grow the economies on the continent. I think that's how you sustain the business on the continent.
Somit?
So, as I'd mentioned previously, first thing we do is back exceptional management teams. So I would say to the African entrepreneurs out there that, if you have ideas and you want to invest in Africa, there are pockets of capital which would be made available for you guys to go build a business of scale, so please, we are very focused on Africa. Like I said, we are looking for really exceptional entrepreneurs who want to build businesses.
And final word, Paul.
I think when we opened the conference, the point I made was that the ingredients are here in Africa. So we as a company, Tullow, we're focused in Africa, we're focused in oil. We've come out of the downturn, I think, is stronger than we went in. And we're back ready for growth, both on frontier exploration and the development production aspects. And I say, the ingredients are here in Africa for us as a company to grow and for many others to grow their business. The opportunity, this is, as you said, it's an underexplored continent. The one word I would say, and the message leaving, is that in Africa, we do need to pick up the pace. We need to move things forward at a pace if we want to continue to compete for global capital.
So measure the ingredients and bake the pie. How about that as an analogy for oil and gas? Ladies and gentlemen, thank you very much for joining us here in the auditorium. Thank you very much to those who have joined in across the African continent for this live CNBC Africa broadcast, coming to you from the Cape Town International Convention Centre, here where Oil Africa Week is currently in session. And of course, we're crossing back to the team in Johannesburg, and we'll be bringing you live insights of the Africa Investment Forum, which is also taking place at the moment. Thank you again. Thank you. Okay, thank you. Great. Whoops. Thank you very much, Frank.
Thank you. Thank you.
Very much indeed, Bronwyn. Thank you very much, panel, for your insights. And it's great that sustainability made it onto this stage, because with my other... please do not leave, please.